I wish I had the answer. So Thursday is the half birthday for that high in the S&P 500 of 2872. That was on January 26th. A couple of things about whether we get back to it. First of all, I think we're probably fixating a little bit too much on where we are in relation to the all-time high. Obviously, we sprinted out to a 7+% gain in less than 4 weeks coming into this year. But if that hadn't happened, we'd be sitting here saying S&P's up 4.8% year to date, on track for a 10% total return for the year. The PE has come down to about the 5-year average on a forward basis because earnings have been so good. You probably wouldn't be saying that there was something broken or the market was stuck. Now, all that being said, I agree this is a prolonged consolidation. It's an unusually long one before getting back to a recovery high if this is just a bull market pullback. And I think part of the unease around it is that there has been some wear and tear in the market. You've had these leadership groups, or ones you wish were leadership groups, like industrials and financials and transports. They've receded, and I do think it's enabled people to say that there's something bigger going on. I don't necessarily think there's something bigger going on. Probably the combination of the brute force of the earnings growth, more time passing, and really nothing scary going on, either on the trade front or something else, would be the formula for getting us back toward those highs. I don't think this is the trip that gets us there to stay. I mean, these rallies have just kind of really gotten tired pretty early, so maybe a slight pullback and then we have to slingshot above it. Who knows? That's just tactical stuff. But I think it's still kind of done just enough, this market, to say it's still a bull market, and until further notice, till it proves itself otherwise.
If tech gets a wingman, and it's the banks, well, the banks maybe are waking up. That can be nothing but a positive sign, Mike.
Sure. I mean, you'd want to see it. I think there's a lot of these groups that have been behaving as if this is a late cycle phase, and we have to be concerned about exactly, how close the end is. If somehow we do get second wind, if we get some kind of, reassurance out there that there are another 1-2 more years on this expansion cycle, on this profit cycle, I do think those groups can come back into favor. It's just not a guarantee, and I don't think the market has been too narrow, but it clearly has become more uneven and more selective. So that's why I think you'd wish for something like that, for financials to bounce where they had to and become more of a contributor to the upside. I just don't know if it's enough yet to be confident that that's going to happen.
Yeah, fair point. Joe?
Mike, I know you look at the entire capital structure. Don't you think if there was a warning signal flashing, it would be somewhere outside of equities? You look at high yield, you look at investment grade, you look at volatility. Last week, those big banks, they reported earnings, they came back, they issued $30 billion worth of debt. The street gobbled it up.
Yes.
There'd be some warning sign, wouldn't there?
I agree with you, Joe. No, there's no doubt about it. There's nothing systemic seemingly going on, especially now, the dollar rally has kind of stalled out for the moment anyway. That was always, to me, going to be the transmission mechanism for when the trade stuff really hurt. It was not going to be about, a little bit less demand, higher input costs necessarily. It was probably going to be about emerging markets, panic of some sort, dollar races higher, and then you have disturbances in the capital markets, which you've really not seen so far. The VIX is telling you it's okay, and as you say, high yield spreads as well.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.